I don't know why my colleagues are smiling. I don't know why so supply and demand zone. So supply and demand zones are specific areas on a price chart where strong buying or selling pressure has historically occurred, often due to large institutional activities. These zones act like dynamic support or resistance level, indicating where price is likely to react or reverse when visited. So for demand zone, we have the buy zone, an area where price previously dropped, paused, then surged upward, showing strong buying interest, often seen as a value area where buyers step in. For the supply zone, which is sell zone, an area where prices previously rallied, paused, then fell sharply, showing strong selling pressure, often viewed as a premium area where sellers upload. So for this demand and supply zones, basically it's another strategy used by most traders out there. So how traders use them? You have identify institutional footprint. These zones highlight where large banks and institutions meet significant trades. So we have dynamics, support and resistance. Dynamic zones act as potential support and supply zones act as potential resistance. Patterns to which demand drop, patterns to watch. We have demand drop base rally, we have supply rally base drop. So for entry and exit points, buy when price re-enters a demand zone expecting a bounce. Sell when price re-enters the support zone expecting a drop. So for the time frame matters, higher time frame like the daily time frame, weekly time frame, this provides stronger and more reliable zones. So for confirmation tools, use volume spikes, candlestick patterns, or indicators to confirm zone strength before trading. So what are the key takeaways? We have supply and demand zones help traders anticipate price virtual and plan entry and exits by showing where large buying and selling activity previously caused strong market moves. They are essentially advanced, more dynamic visions of traditional support and resistance. So here is a quick diagram of mastering support and demand zone. So if you notice, this becomes a supply zone, this becomes a demand zone. You see how the market rally around this particular zone, causing it to become a very strong support zone and a very strong demand zone. So for candlestick analysis, we have candlestick anatomy. Candlesticks virtually shows price movement for a specific period of time, revealing market sentiment and potential reversals. Each candlestick has a body and wicks/shadow with color indicating direction. So what are the key components? We have the body, which is also known for the real body, the thick rectangular showing the range between opening and closing prices. We have the bullish up candles, close, open, typically green or white. We have the bearish, which is also the down candle, which is close, open, typically red or black. So we have the wick, which is also known as shadow or tails. It's always a thin line extending from the body. You always see it like a thin line, the body of the candle. You also see it. So we have the upper wick shows the highest price reached. Lower wick shows the lowest price reached. So how to interpret candlestick? So we have the long body, strong buying, bullish or bearish pressure indicates a decisive movement. So we have the short body, little price movement, signals indecision or balance between buyers and sellers. So we have the long wick, which is also known for high volatility, price tested extremes but closed near the open. We have the Marubozu, which is known as the no wick at all. Strong momentum, open or close is also the high or the low for that exact period of time. So we have the doji candle, which is very small body with roughly equal wicks. Extreme decisions. It's open and close. What it tells traders, market sentiment shows whether buyers, which are the bulls, or sellers, which are the bears, are in control. Strength of move, longer body indicates stronger conviction, shorter body show weaker momentum. So we have the potential reversals or continuation. So patterns formed by bodies or wicks like hammers, shooting star, spinning tops can suggest trend changes or continuation. I have a diagram showing how it all looks like. So this here is the real body. This green part here is the real body of a candlestick. Then this is the open, this is the close, and this is the open. If this is a sell candle, this is going to be the open and this is going to be the close. So this is the upper shadow and this is the lower shadow. Then we have the low and we have the high. As simple as that. So number two, we have bullish and bearish candle. Candlestick indicates whether buyers or sellers are in control, helping traders anticipate potential price movements. So what are bullish candles? We have the definition: close, open, buyers pushed the price higher during period. So we have the typically green or white. We have the hammer. We have the bullish engulfing, a small bullish candle followed by a larger bullish candle that fully engulfs it, suggesting strong buy pressure. So we have the morning star, three candle patterns signaling a potential reversal from a downward trend. So we have the bearish candle, we have definition, we have the close, open, and sellers dominated, pushing the price lower. We have typically red or black color. So for key patterns, we have shooting star, small body at the bottom, long upper wick indicates sellers pushed the price down for highs, signaling potential reversal. So we have the bearish engulfing, same. We have the hanging man, same shape as a hammer but appears after an upward trend, warns of potential weakness or trend reversal. So what are the key takeaways? We have the bullish candle equal to buyers in control, potential upward movement. We have the bearish candle, sellers in control, potential downward movement. So we have pattern need confirmation from other indicators like support and resistance, volume or trend lines to avoid false signal.